Thank you, sir. Great power comes great responsibility. Awesome. Good afternoon, everybody. Can everybody hear me? Testing 1, 2, 3. Put this down here. Awesome. So I guess before we kick off, for some of you perhaps who were here earlier, I'd love to maybe give a brief introduction to maybe ourselves and SeedLegals. So let's start with the most interesting one, SeedLegals. So SeedLegals is a legal tech automation platform with arguably 3 things at front of mind. 1, helping you get investment ready. When you think of investment readiness, we're thinking about SEIS, EIS advanced assurance, ensuring that your personnel has sufficient team documents signed, and also just getting you ready in regards to enough shares in your company, so on and so forth. Then we look at actually the raise itself. So actually we have a platform to help you raise investment anywhere from a modest family and friends round of perhaps 20 or so thousand, all the way to maybe a larger round of Series A up to 5 or so million. And the third part, in my opinion, somewhat biased, is the most interesting, which is the idea of retention, motivation, and attraction of talent. And we tend to see options or share ownership as being a great way to do so. Because for the last 2 years at SeedLegals, my only thing I've done is actually help founders create option schemes and help them incentivize and attract talent here at SeedLegals. I guess I'll pass over to Lily.
And hello again to everybody I saw this morning, but yeah, to anybody new, I'm Lily. I'm on the account management team at SeedLegals, so I guess cover a little bit of everything when it comes to helping people really plan out investment rounds, that readiness, usually more in subsequent rounds as well. So once you have done that initial round, how do you move forward towards the next? Agile funding, and yeah, also helping out with share option schemes, which is interesting.
Awesome. I think we're good. Awesome. Saturday's focus. Great. New clip. I'm getting used to it. Today's focus is equity. Let's dive straight in. So I guess the first focus here is, what are shares? And I guess there's 2 different mechanisms we can use when we're looking to give equity to our staff, our team members, or arguably anybody in the company. There's shares and there's share options. There's clear distinctions between the 2, clear scenarios where one would prefer shares compared to share options. Shares are typically best for super early stage companies, whereby which we haven't raised investment, we aren't revenue generating, whereby which you can argue the value of the company is nominal and nil. So a good example would be, I've just incorporated my company with 100 shares. Me and Lily are co-founders. I decided to incorporate the company because it's just easy for me to get a bank account that way. And then simply, I'm going to give you Lily 100 shares because we're equal partners. That's probably the best scenario to give shares. When we look at share options, this is more so in scenarios where we've raised some investment, whether that is an ASA or more traditional funding round, where we're revenue generating and there's some value to the company of which perhaps we haven't defined, or we need to work with an external accountant to actually do an independent valuation to the value of the company's worth. Anyway, at that moment in time, it's preferable for us to give shares to our team. The question is perhaps why? Well, simply to give shares of a company who's generated revenue or has perhaps raised investment would open the individual up to some immediate income tax liability in some cases, ranging anywhere from perhaps 20% all the way up until 45%. So with share options, the goal here is how do we do 2 things in an ideal scenario. 1, defer tax liability to a later date, and then 2, how do we minimize the actual tax liabilities yourselves, your team members will be subject to. This is what share options are really here to do. So behind us, we should see a cap table, share register, or a capitalization table, which should show us shareholders, the amount of equity they hold, their voting rights, the voting right percentage, and the very, very last column should be the investment amounts. We also should see somewhere near the bottom, perhaps my head is in the way, we should see a line item called option pool. And this option pool is the set of shares that yourselves and or perhaps 75% of voting shareholders in most cases, perhaps even your investors if you're at that stage, will agree to set aside with the focus of actually giving equity to your team. The key thing to know here and why this cap table is on display is that a byproduct of creating a share option pool is yourselves, your shareholders will be diluted. Now we should see some shareholder numbers, we should see shareholder and perhaps a fully diluted total as well. This fully diluted total showcases what our equity in the company would drop to should the entire option pool actually be exercised. Now, how likely is that to actually happen? In some cases, yes, But in some cases, what you actually find is you may give 5 or 6% of your 10% option pool to your team, and then maybe at the point of acquisition, there's still 4% left. And then simply that's up for you to do whether you want to allocate the pro rata to the founding team or to give to your team members. The key thing here, especially for us here, we're looking to raise investment, is this idea of a pre-money option pool. And the pre-money option pool simply means that only the current shareholders will be diluted as per the agreement to increase the option pool, or to even create an option pool in the first place. Why this is important is more so for our investors. We don't want our investors to inject arbitrary number of money into the company and as a result be diluted immediately. So simply this allows them to invest after the option pool has been created, and as a result they won't be diluted. As arguably it's quite typical in at least the UK for this to happen. Your investors probably pressure you into doing so. When I say pressure, I mean a polite push, aka legal team will tell you, hey, sign this term sheet with this pre-money option pool, or you get no money. So again, a soft push, not forcing you in any shape, way, or form. And it's simply because it's in the investor's best interest to have this structure in this particular way. Anything from yourself?
Not in particular, I think. Yeah, not in particular right now.
What do we have here? Awesome. So we have the idea of consents and things required for us to actually grant options to our team members. There's a few different pathways to maybe explore here. Pathway one would be we're a newly incorporated company with just a founding team here, which is great. It really means that we control the reins. We can do as we wish. Again, as long as we have that 75% voted shareholders approval, we can do as we wish. If we perhaps fast forward to 4 or 5 years where we have maybe 30-40% of the company has been given away to investors at a series of stages, maybe the institutional funds, we now need some consent in order for us to actually increase an option pool. And typically allowed would be investor majority consent if we've given majority consent in the most recent funding rounds, or if you have a VC or some type of institutional investment in a company on the cap table, they will also need to approve the creation of this option pool. If we have given these type of consents, they'll also need to approve a lot more, which is why it's always perhaps good to pick investors that like us and investors that we like, because unfortunately we probably will need their help to run our business going forwards. Nice. So what we have here is the 3 things I believe that most companies are trying to achieve in some shape, way, or form when they look to give team members equity. And I say the word team members quite loosely because this can encompass a wide assortment of individuals. We had a gentleman over there who spoke about a startup which is looking to give some of these high-profile athletes some equity in the company. Loosely, they would fall into one of these categories. This team bucket I'm lumping people in, anywhere from our consultants, our advisors, our part-time staff, our full-time staff, our dev team, offshore, and perhaps even here in the UK, all fall under this team umbrella. Now, there tends to be 3 things we focus on. We'll probably go through them in what you could argue is the correct order. So we have this attraction piece, right? So we're startup founders, we are equity rich, cash poor. Maybe we have team members who we've been able to entice to work at our startup from posting at workinstartups.com. We managed to get 1 or 2 people to actually come on board. We promised them equity, maybe 5 or so %, working about 10 to 15 hours a week. I say this because I've done this myself, and simply that's the value proposition. Join my startup, you receive some equity. It perhaps gets to a stage where we're now looking to give them a full-time offer, and now we need to perhaps steal them away from maybe their corporate job or whatever job they currently have, which has perhaps benefits, a nice stable income, and key emphasis on this stable part here. So how do we do so? Well, we typically give them the allure, the promise of options, ownership in a company to either subsidize the amount they are not going to make from leaving their company, or give them enough of the pie once we've articulated where our goals for the company is. For example, 100 million market size, 100 million valued company. As a result, you receive 5%, start to see the dollar signs in our eyes light up, and you realize, oh yeah, this is a good idea. I can leave my job, you're giving me X for the opportunity to make 50X, right? Which oftentimes is the value proposition we sell to our team members. The second part is probably this retention piece. And I think I'm relatively young, I probably fall into this millennial group. tends to be some level of high attrition rate with young workers. Tend to leave companies well before 2 years, probably 18 months is probably where you start to see most your younger team members leaving a company. So with this idea of retention, the goal really here should be to align our medium to long-term objectives with the team member. And by medium to long-term objectives, the timeframes we're loosely working on are probably, I'd say, 3 to 5 years, whereby which the narrative is, hey, you work for us for 3 to 5 years, you receive 1% of the company. After your 5 years, you're now able to buy your equity from the company, perhaps sell it if you're lucky. You could sell it on the secondaries market, similar to what Revolut have allowed some of their team members to do, and become a millionaire, it seems, overnight, which ultimately is part of the law of receiving stock options. Unfortunately, we're not as fortunate here in the UK to have as many examples, but there are a few companies here in the UK whose team members have literally become not just on paper millionaires, but actual millionaires with realized gains as well. There's a few who work at SeedLegals, so I can speak from a personal place. And the latter part is probably this motivation piece, right? So over this last perhaps year of COVID, we've seen an influx in companies from what we'd probably argue to be non-traditional paths looking to give equity to their team members. And by non-traditional paths, I'm probably referring to accountants, electricians, plumbers. Typically at SeedLegals, we just see tech startups. Super weird to see electricians want to give equity to their team members. I was like, why? What's going on here? Well, they realized that one, the opportunity cost for them to actually give those cash bonuses, perhaps on a quarterly basis or semi-annual basis, annual basis, whenever they do so, was actually rather expensive. And they were looking for a more cost-effective strategy to actually keep team members motivated and keep team members engaged. And they found that equity was a great way. Just to give some context to that point there, you may give team members perhaps a 5K salary bonus per quarter. That's 20K a year, not including any additional costs required in the hiring process. Compare this with stock options, where the average cost to set up an option scheme, depending upon where you go, ranges from 2.5 to probably a high end. Let's say 20 grand. That's BDO. Let's ignore them. They're extremely expensive. Let's say somewhere between 2.5 grand to 8 or so thousand across the whole company. And now you start to see, all right, it really is more cost economic for myself to maybe give equity to my team rather than give everybody a cash bonus. Nice, awesome. So this is probably one of my favorite slides here. It's this idea of a hockey stick curve. This should be a slide that hopefully we'll be able to share in our investors' decks. And when they see this, this is typically when they sign the dotted line and actually deploy the capital. Up and to the right is probably a slogan that we probably will become familiar saying if we haven't already. And simply what I'm trying to articulate here is all of the stakeholders, the individuals involved in this option given process, equity given process. And how I see it is Lucy, there's 4 individuals. There's the employees, the team members like myself and Lily. There's the founders like yourselves. There's your investors. And oftentimes there's the backers of your investors who actually give your investors the capital, because in most cases your investors are just capital allocators rather than the capital themselves. And it's simply all of these stakeholders are waiting for you to hit this inflection point whereby which, whether it's your traction, your revenue just goes up and to the right. And you're probably thinking, like, sure, AJ, this makes sense. Like, where does options come into play here? Well, I think options should really be the motivation and the tool by which we can actually help our team members achieve their particular milestone. So we give equity to our team members, we get them brought into the vision. They work hard, they hit their individual milestones. As a result, we as a startup founder, we hit our personal milestones. As a result, we can raise investment, perhaps at a larger valuation. As a result, our investors are happy. They've seen again, on paper, upside in their investment. And ultimately, our investors are happy because, again, they've been able to receive a 3-5x return on their investment. Again, on paper, not yet realized up until either secondaries or we sell. So you kind of really can, when I hopefully articulate it, you can kind of see how options plays or equity and culture plays quite an integral part in the success and the lifeblood of a company. And I truly do believe if we have happy employees, happy staff that work hard, hardworking employees, it's so much more easier for us to hit those top level metrics that we as founders need to hit for us either to raise more investment, or if that's our pathway, or my preferable option is we never raise investment at all. We look at a platform like Uncapped or Pipe and find different ways of financing in an equity-free fashion. That's a shameless plug for the team at Uncapped and Pipe. Shout out to Harry Hurst, he's a UK person in America doing amazing things. Awesome. So now we look at perhaps share options. So we've loosely walked through what shares and share options are. We've walked through perhaps the motivations and the things we're looking to achieve by getting these set up in the first place. And now perhaps the final piece of the puzzle is maybe the types of share options that are actually available to yourself. There's actually perhaps a plethora of option schemes available in the UK. We're extremely fortunate. We have the EMI scheme, the KEEP scheme, the CSOP. Conscious, I'm just throwing acronyms at you as well, just random things. I feel it's like an internal language. You kind of feel cool saying them. You probably go over to your partner and say, hey, I need to learn about the EMI today. What's that? Type in on Google, you probably won't find it. It's terrible for SEO. But anyway, there's a plethora of option schemes available here in the UK. And we're extremely fortunate that we have the EMI, which is, in my opinion, one of the best mechanisms by which we can give equity to the team members. Now, AJ, that's a bold claim. How can you substantiate that? Give me 2 seconds. So in essence, the EMI allows us to give equity to our team members at a discount. Just to give some numbers, let's say we've closed our most recent investment round at, let's say, £1, or the company's worth £1 with the EMI scheme, depending upon the service provider that you decide to use, hopefully SeedLegals, but if not, no worries. You can actually argue an aggressive discount. The industry average tends to range from 60 to 75%, depending upon who you ask, what websites you search this information on. Our average at SeedLegals is 93%. Now, what does that really mean in reality? Well, it now means for a company whose shares are worth £1, we can now grant our team members equity at just 7p, which makes the cost of our team members buying the equity a lot more affordable, and also it leads to a greater upside. There's a few case studies we have internally at SeedLegals of team members such as Freddie from HelloFresh, one of the super early team members at HelloFresh, sold his options, made a small fortune, and now has been able to reinvest that back into his startup, raise more money, give his team members options, and hopefully the cycle repeats itself. It's typically a cycle we tend to see in the US, so always great to see that here in the UK. A following question could be, AJ, the EMI is awesome. How do I get one set up? How am I eligible? Hopefully, if I've timed this right, we go through some of the qualifying criteria. Have I done it right?
Yeah.
Nice, awesome, sweet. So the EMI, again, we've gone through it. It's one of the most tax advantageous option schemes available compared to you giving your team members just ordinary shares today, where literally today they'll be subject to 20, 40, or 45% income tax depending on their bracket. It's just a tax liability that nobody wants to pay. Some would argue the taxes in the UK is very draconian. I think, no comment on that point. And again, the goal here with options is to minimize the tax liability for our team members. And EMI does that best. The other option schemes I've made reference to, CSOP, growth shares, tend to be able to give our team members somewhere between a 20 to maybe even 40% tax liability, which is a large amount compared to EMI, which is just at 10%. So nice. So you probably are wondering, am I eligible? How do I know? I know some of our businesses here because I've heard some of us pitch at different events. So I know you, sir, are eligible for the EMI because I'm new to the business. I need to talk more perhaps later. But if you need a beta test, I'm still here. But the focus for the EMI is, am I an SEIS and EIS eligible business? Now, again, more acronyms. So let's actually explain what these acronyms mean. The SEIS and EIS are the Seed Investment Enterprise Scheme and the Enterprise Investment Scheme. And in essence, they're schemes created by the government circa 2003 to, in essence, incentivize investors to invest in high growth startups by giving them a tax rebate, somewhere between 50 to 30%, depending on whether you're SEIS or EIS. There's a list of eligible criteria that HMRC have made reference to. And the goal really is just to go through that list. If we don't see ourselves on the list, good news, we should be EMI eligible. As long as we have less than 250 staff, we have less than 13 million on the balance sheet, and as long as the individuals we're looking to give equity to have less than 30%. I think this last point here is probably interesting for everybody here. It should be, because this 30% is probably, hopefully, where we find ourselves above as it currently sits. If it's not, then the EMI is actually an opportunity for you, again, consent from our investors and our shareholders permitting to actually bring our equity up to a palatable amount. So keep that in the back of your mind if you go through a series of dilutions, which is perhaps one of a founder's biggest fears, is being diluted. Funny enough, it's also inevitable at the same time. EMI is a great opportunity for you to like bring yourself back up to a palatable number. Again, as long as you have consent from your investors.
Just had a conversation with somebody about that today.
Perfect.
They were saying it's investment we're not sure we want to take on. Can we put in an option pool as well to mitigate that with KPIs with those investors? So it's kind of also a handy way of kind of tagging along with a raise if you are at a later stage and not quite wanting to sacrifice that at the same time.
Perfect. Awesome. So when we set up an option scheme, there's rules that determine how the equity is to be allocated, and loosely we're referring to across how many years will a team member have to work for us to earn his or her options. What's the bare minimum of time they need to be employed by the company before they earn their equity? What happens if the company is sold earlier than we anticipate? Do we want acceleration provisions? What happens if, when can a team member actually buy his or her equity? And all of these components are things that we map out when we set up the option scheme rules. Now, they sound quite complex, and I've had the pleasure or perhaps fortunate situation of having to speak to accountants for the last 2 years, and depending upon your accountant, maybe you'll laugh at that joke. But in essence, the option schemes tend to be made out as very, very, very complex. I assure you, I could actually hop on the SeedLegals website, go for an option scheme with you in about 10 or so minutes. And hopefully, if I've done my job well, you'd actually understand the elements of an option scheme. So what am I trying to say here? The option schemes rules sounds very, very daunting to some, but I promise you there's perhaps a list of 14 or so criteria that you need to be aware of. You need to perhaps understand what the implications if I select X, Y, Z. And again, there should be a solution online to actually help you with this whole process. One thing to note is, back to the earlier example, we spoke about that discount compared to the most recent valuation, whether it's a £1 valuation, share options actually being 7 or so p. The greater the restrictions to share class you give your team member, the greater the discount is going to be. So my recommendation is always to keep it quite simple. We'll typically have ordinary shares yourselves have as per a corporation. You may have an investor who has a different share class, perhaps the ordinary share class, or some preferred share class if we're at a later stage. When we look to give equity to our team members, we tend to see us giving them a share class with some restrictions, perhaps a B ordinary non-voting share class. Now, what restrictions you decide is perhaps a personal choice more so than anything. What we tend to see here at SeedLegals is companies tend to opt for no voting rights and no dividend rights. So in essence, the share class is solely an asset to appreciate over time. Hopefully it will be similar to people's crypto portfolio and just go again up and to the right, that inflection point, bring it back, bad jokes from before to the surface again. One love, thank you, sir. Big stretch. Awesome. So we ran through this example of the discount. Just to give an example, we have a 30% or 30p exercise price here, which is actually the market average. So again, pretty poor if you speak to me honestly. And let's play an example of the company appreciating value from £1 per share to £10, and let's say 4 years is quite a nice time for an investor to be quite happy with that. And then simply when it comes time for me or Lily as the employees to exercise our options, simply now we pay that 10% capital gains tax on the difference between the sale price and the actual price that we purchased the shares for, compared to when we receive unapproved options, or in some cases other option schemes, where now we're subject to the full 40% tax rate, which is it's like an absurd amount. Compared to EMI, just 10%. So again, realistically, the EMI should be the first thing on our mind. I think the next slide is us politely educating you that the EMI is really the best. Awesome. So if we are SEIS and EIS eligible, I assure you to look at the EMI first, disqualify ourselves if we perhaps aren't an eligible company. And by eligible, perhaps we're looking at those who operate in the fintech space, those who operate in perhaps the property development space, those who do lending, borrowing, financing, things of that nature. You may or may not be eligible. But also, if you craft a compelling narrative in your SEIS and EIS advanced insurance application, you may surprise yourself. So give some context. SeedLegals legal tech platform, if you look at some of the non-eligible activities for SEIS, it's actually providing legal and accountancy services. So on paper, you would assume that we are SEIS, EIS eligible. From crafting the appropriate SEIS advanced insurance narrative, we've been able to one, give our investors SEIS and EIS, also set up an EMI scheme, which hopefully the team members will benefit from. So if you aren't necessarily too sure if your SEI is eligible, then it's always worth us actually submitting a high quality advanced insurance application, getting that green light, or if you get a thumbs down, then simply then you know the EMI is out of the options, and then maybe it's best to look at growth shares, CSOPs, or alternative option schemes. So we've spoken about the types of schemes, we've spoken about how options tend to vest. Now we're in the home stretch, so to speak, and we'll cover the different types of vesting. So we have exit only, milestone based, and time based. That's actually in the order of popularity, with time based being the most popular. All of them have potential upsides, potential drawbacks. When we look at exit only, it's based on under the understanding that your team members can only exercise, buy their options when the company is sold. Now, this has a few upsides. For example, if we as founders are aware that our game plan is to sell the company within 5 to 7 years, I think exit only works quite well for us. We can get our team members bought into the vision. Hey, the exit date is XYZ, aspirational valuation is X. Here are some of the key criteria that we need to ensure that we have in place for us to be attractive to our investors. Hey, let's work our way backwards, which is perhaps what some of us are doing in our internal companies, working our way backwards to make sure the acquisition is juicy for everybody involved. And I think this works well. The only perhaps drawback to this approach here is many founders have the dreams and hopes of an acquisition, but seldom do they actually materialize for whatever reason. And what you don't want to find yourself is in a situation where you've promised perhaps your whole staff equity subject to a sale happening, and the sale doesn't happen. Because then what happens next? Now someone will argue you have these disgruntled, demotivated team members who have equity which they can't actually realize for another 10 years. And again, if we look at those 3 reasons why we're looking to set a scheme up, it's that retention, motivation, and attraction of talent. If the exit doesn't quite go, then that retention and motivation piece just go out the window. And arguably so does the attraction point, because they're already in the company. And now in essence, we have an option scheme that perhaps hasn't actually met its purpose. So again, always cautious to keep those 3 things up front of mind with our decision making around options. Another perhaps drawback to this is the element of unfair treatment. So there's 2 types of exit only, which is quite interesting to me anyway. It's exit only, whereby which an individual leaves the company and then the sale happens and he or she, or their apologies, can still exercise their options. And you have exit only, whereby which if you're not with us at the point of sale, you lose everything. And that is what our chairman at SeedLegals will tell me is how things used to be when I was in my underwear. My diapers more accurately because of my underwear this morning. So that's more accurately. So again, always keep these 3 things up front of mind: this retention, this motivation, this attraction piece. Is the option scheme I'm setting up helping me achieve these 3 goals? And if it is, then I think we're in the right direction. Then we look at milestone-based vesting, which arguably is the second most popular, tends to be extremely popular in the US. They tend to have a hybrid approach of milestone and time-based. It's come into the UK slowly. We tend to be perhaps a few years behind the US, unfortunately. And simply milestone-based vesting is based on the notion that, hey, here's KPIs, here's objectives, you hit these, you receive your equity. I think it works quite fair. It's really impactful when one operates in an area that is perhaps very, very numerical driven. So our sales team, our marketing team generate X number of SQLs, generate X number of SQLs, sales reps to hit quotas of XYZ. They receive 0.1 equity every quarter for doing so. Works amazingly. Where perhaps it falls short is with some of the wider functions. So what milestones do we have for our tech team outside of deployment speed? It's an open question. If you have any answers, let me know, because people keep asking this question. I don't have an answer for that. Right? So perhaps it's very difficult for certain functions to receive milestone-based vesting. Another thing is that perhaps it could open the team members up to the element of unfair treatment. To give an example, let's say we have sales reps, their quota is 100K in revenue per quarter. As a result of achieving this, they receive 0.1 equity. What happens if our sales reps fall short and just hit 70K? How much equity are they now entitled to? Unless we've actually accurately mapped these out in some of these milestones, the answer is just 0, right? So again, it could open our team members up to unfair treatment unless we actually articulate this in a fashion which suits both parties. And last but not least is the tried and tested, the go-to, the 80% of people on SeedLegals tend to go for this option. It's time-based. And time-based tends to be the most popular. Again, it tends to align our team members' objectives, or it should do, with this 3 to 5 year time frame, whereby which team members are aware they work for the company for this number of years, they will receive the full amount of equity that we promised them. One of the main drawbacks historically is it's been quite difficult to manage time-based vesting when we grow our team from perhaps 5 to 20 to 100. Now with digital solutions, again, shameless plug, like SeedLegals or those available, a digital platform is actually all you really need to keep track of all the vesting for your team members. So hopefully we made this a lot easier. Again, we tend to see 80% of founders will go for time-based because it's tried and tested. And I think in my opinion, it works quite nicely with that retention piece, ideally trying to keep our team members here active, engaged for the next 3 to 5 years. And those tend to be the timeframes we tend to work around. So the elephant in the room is when our team members leave. It's always a somber topic that is quite difficult to talk about. We want our talent to stay here, but unfortunately, an amazing war on talent right now. Some people tend to think the pasture is green on the other side, but arguably the pasture is always greenest whenever we water it. Team members can leave. One thing to note is the treatment of team members when they do. So there's 2 types of leave provisions, quite loosely. There's time-based, so there's good leavers, and there's our bad leavers. Always best to focus on bad leavers. It's the sexiest, it's bad. And bad leavers are in essence people who are fired for whatever reason, whether it's gross misconduct, negligence, or so on and so forth. And the sentiment, unfortunately, depending upon your stance, is they lose all the equity that they've been promised. And the equity that they've lost, they've lapsed, they've forfeited, they've foregone with their terrible actions, goes to the option pool to be allocated to more worthwhile team members. Yeah, new blood in the company, so to speak. And then we look at good leavers, which is anybody who's not a bad leaver. And typically the sentiment is, they can exercise the options that they've earned pro rata based upon their time they've been with the company, as long as they're a good leaver, which is determined by yourselves and the board. You have 30 days once the team member is left to determine if they are in fact a good leaver, and then they actually have 90 days to decide whether they want to buy the equity from the company. If they do decide to buy the equity from the company within those 90 days, under the EMI scheme, then that 10% capital gains tax liability, or entrepreneur tax relief, as you perhaps may know it as, or business asset disposal rate, which you perhaps don't know it as, but HMRC wants us to define it as going forwards, will be kept for them if they exercise within, again, 30 days of their departure. And then we look at perhaps exit-only schemes. So if a team member leaves tomorrow and it's an exit-only scheme, well, unfortunately, they just can't exercise up until the exit occurs. So I've had cases of founders who've left companies, set up their own new companies, and in the process of trying to raise investment, one of the old companies has actually been sold, and they're actually able to finance their own investment round using the upside of their most recent acquisition of their previous company. I have 3 examples out of perhaps the thousands of founders I've spoken to, so don't hedge your bets on that being the solution, but it's quite interesting to see at times these acquisitions, again, do take longer than we expect. We want a 3 to 5 year turnaround time, but perhaps we need to look at larger time frames, maybe 7 to 10 or so years. And then here we have a provision based upon acceleration. So acceleration upon 2 different types of events. 1, a sale happening earlier than we anticipate, or 2, an IPO. If we focus on the sale, different thoughts and views and philosophies on this, actually quite interesting. So if you were to read the index venture framework, they tell you that only 33% of option schemes will have acceleration upon a sale, meaning that you will hear with a company for 4 years, the company is sold in 2 years, we promised you 1,000 options, you'd only earned 500. Acceleration provision allows you to receive an additional 500 under the caveat that you continue to work for the company for what's referred to as an earn-out period, typically tending to range from 18 to 24 months. In most cases, it tends to be reserved for quite senior executives, and by senior executives, founders, C-suite. Why? Well, in essence, we don't want to put our investors or new acquirers or new business owners in a situation where we now need to re-incentivize team members who, in essence, are just counting down the days before they can decide to leave the company and go retire in the Algarves and get a beautiful place in Biltmore and just spend their mornings on the beach. Maybe just myself. That's my dream there. So again, here, senior executives, in some cases, we do see acceleration. For junior staff and junior team members, it tends to be very seldom and very few and far actually in between. Oh wow! And we're here. I told you we're on the home straight. Any questions? Please fire away.
Thanks, Adrian. Really. Any questions, Mary?
Yep.
Russell. I'm a customer actually.
Wait,
So yeah, really cool. One of the questions I've got is I've got a round opening now for Seed. Got a couple of VCs interested, which is really cool. But what we need to do, we've kind of got some good traction. We've got a design partner, which is a GSI. We've got some big UK government customers ready. But the VCs are wanting us to sort of show a bit more actual traction before they'll jump in. So one of the things that I'm looking at doing is sort of creating a smaller pre-seed with some angels, if I can. One of the things I know I need to do is look at the EIS and the SEIS. When I looked at that, the first thing it asks for is like an investor or investors to put down for the application. And at that point, I'm stuck. So I've got lots of people plugging into my space and my network that's live, ready to execute and go to market. But in terms of angels, I don't. So what do I do at that point?
It's a chicken egg scenario, and our SEIS and EIS team always say it, but don't say it. But HMRC rarely actually will get and follow up with the person that you put on your application.
Right.
And it's also important to note, like, so long as that person is eligible for the scheme, it doesn't matter if they follow through or not. So one, you can ask a favor of one of the angels that you're chatting with. Can I use you on the application? 9 times out of 10, they probably say yes because they're the one benefiting from it. There is actually no obligation for them to follow through with the investment. Equally, again, friends, family that you can name who are eligible for the scheme. Again, UK taxpayers are eligible for the SEIS and EIS scheme. 9 times out of 10, you should be able to find someone because they are the people who are going to benefit from it in the long run.
On that point there, friends and family, I think some family won't be eligible. So it's probably best going on to...
Not parents or children.
Exactly, yeah. So just type in back eligible SEIS, EIS investors, SeedLegals, and hopefully our marketing team are A-Styles, and it should be SEI.
So I've got a couple of advisors on the board, but they can't, I don't think they can invest either. And one of them would be the right profile, but he's an advisor, so I can't.
They should be able to.
Does he own equity in the company?
No, he's basically, I've created an option pool that will execute when we get the funds.
I don't see any reason why he can't.
Yeah, he can.
Right?
He can apply capital, he can put him on the application.
Right, okay.
And then you can give him options on the back end as well. So that's a nice thank you.
Very good.
Yes.
Thanks.
One more down here. Hi, just a question about the option pool, because I know in other countries that you cannot create it. You can create the option pool, but you must have capital, social capital, or you have to use the profit of the company to create the option pool. Here it's the same, right? You cannot just say, I want to allocate 100 shares as option pool at this value if you don't have the profit to cover that amount of shares that you are issuing. That's it.
So you can create an option pool from the day of incorporation. So you literally could create a company today and incorporate with about, let's say, 100,000 shares and create an option pool of 10%, which is like 1,111 shares.
Yeah. If you do that before any fundraising, it's fine. Because if you buy 10,000 shares at 1 penny, it's 100 pounds, it's fine.
Sure.
You know? But if you are doing, for example, fundraising at a market value of 1 million, and you want to allocate 10% as of option pool is 100K. And so in Italy, for example, you cannot do that if the company doesn't have a profit that you can convert in a capital share to, prove that the money is there to as assurance for the employees who are taking those shares, those options or shares, actually for the shares, because the option is different, but for the shares, you know what I mean?
Sure.
So I don't know if here in
No, in the UK it's a lot easier, which is perfect, right? You can simply, as long as you've closed the investment round or before the investment round, you've agreed again, this pre-money option pool, you can grant as many options to your team members. Only caveat to this is you need to agree upon the valuation of the options with HMRC, which will actually be a lot lower than the 1 million market rate that you've actually made reference to. Once HMRC have agreed upon your valuation, which turnaround time is 3 to 4 weeks, then there's a window of time, 120 days, that you can grant those options to your team members at that HMRC approved price, and then simply just need to notify HMRC within a lot of dates to be aware of. Notify HMRC within 92 days of you granting options to those team members, and then simply every single year before the 6th of July, you need to just notify HMRC of any changes to the option scheme, if anybody's exercised, anybody's purchased their options, and that's it.
Okay, thank you.
Awesome. That's a lot of days.
Again, one more. She was
One more.
one more. Sorry.
Oh.
I mean, I'm gonna sound stupid, but when you said that the employees can sell their shares back, who to?
That's a great question. No, right. So it's a great question. So I guess there's a few different ways for liquidation. So one is other shareholders. It tends to be a pecking order as agreed per your articles of association. Loosely, it tends to be shares need to be offered to the company, founders, shareholders before they're offered to third-party individuals. So any one of those individuals, but also they could be to a third-party individual. The ideal upside for an employee. So I used to work at Apple. They give you some equity, and then they buy the equity back from you. Unbeknownst to me, it was a great financial decision to just receive equity from Apple. And again, that's the incentive, right? So the ideal goal really is your company buys the equity from you. If not, you're able to sell your equity to maybe another shareholder who's perhaps in the company or wants to be in the company. Or there's an opportunity for when the whole company is sold, you simply sell your options as part of the larger sale, and that's when you receive the large upside from the sale. No worries. Say the best for last.
Absolutely. AJ, Lily, thank you so much. Thank you guys.